I appreciate you watching another video. And in this video, we're going to talk about the kicker candlestick pattern, also known as the kicking pattern, which is a 2-candle bullish and bearish reversal pattern. And really, it's a strong sign of the reversal of whoever is in control of the instrument that you're currently trading. So if we know the market's a constant battle between buyers and sellers, right? Higher and lower prices. The kicking pattern will show an obvious shift in the sentiment in the market, right? It's going to clearly favor one side, even if it's only for the short term. Now, this pattern generally happens after when the news that affects the market's released, okay? So the market's closed, news comes out. Upon opening, we'll see the pattern. And traders will adjust their positions, they'll exit, or even enter trades. Now, instead of always looking for the perfect pattern, understanding the psychology of this pattern is probably more important. First, let's define what a bearish kicker is. Okay, basically it starts during an uptrend. We'll see a large momentum style green candle. Now, the momentum candle, that's preferred, okay, but it's not a definite requirement. We just want to see a bullish candlestick in the direction of the overall trend. The next candle will essentially gap lower. It's red, little to no lower shadow, and that's bearish, obviously. Now, this is a daily stock chart of Arista Networks. So what we're looking at is a gap down in price, okay, while price is in an uptrend. An important note is between those two candles, there's no overlap of them, okay? There's no attempt for that red candle to seek out a higher price point. Now, the red candle actually almost closed on the low of the day, just a few cents off. So what's the psychology behind the bearish kicker? Well, any large move in price can shock a trader. So if we look at a large green momentum style candle, we know that they're going to draw in more buyers, and it's going to further drive the price up because they fear missing out on that big run in price, right? FOMO, the fear of missing out. It's kind of the same thing with this pattern. So I want you to imagine you're long in this example, or you're sitting on the sidelines and you're looking to short. So if you're long and then you see this kicking pattern steps in, what are you going to do? Well, you're going to immediately see a loss of profits, right? So it's going to cause a lot of traders to exit. So if you're on the sidelines and you're looking to short it, well, this candlestick pattern is a strong sign of bearish intent, right? So just understand the thoughts that go through a trader's mind when this pattern happens. So trading the bearish kicker, so we understand it's a bearish sign. And when traders don't see any price attempt higher, they want to unload the positions that they're holding. Now, you'll want to use a lower time frame chart for an entry, and depending on how price evolves, okay, you could short the rally or trade a break of the range. So in this instance, we're using the daily chart to see the kicker at the open. We're going to understand what that pattern means. We're going to see the bias for the trading day. And on a lower time frame, we can use a price pattern such as a break of a trading range or a pullback. But instead of just using the kicker as information, we can also trade it. This is a 5-minute stock chart. And at the open, we get the gap up in price. So in this example, we will see two possible ways you can trade it. And it all depends on what price does. At number one, we could just sell a break of the low. It's a viable approach. And in this example, price drove $1.15 down to the lows from a break of number one. But number two, you'll see price trying to fill the gap just a little bit. We get a higher high, which means at one point that candle was actually green. So once it turns red, traders could enter a position and what's called a momentum shift. So once you sell, your stop will just go above the high. And entering there actually increased your profit potential to $2.09. And it only cost you a few cents in risk. So you want to have a few techniques to trade the pattern. That's important because we never know what shape price will form after that kicker becomes confirmed. Will we get a pullback? Will price pause to give us an entry? We never know until it happens. What's the bullish kicking pattern? What's the exact opposite of the bearish one? Our first candlestick will be red in the direction of a downtrend. The next candle will open above the red candlestick and be green. Okay, this is a 5-minute stock chart of F5 network. So number one, we're actually in a downtrend. It's defined by a price structure, lower highs, lower lows. Number two, let's say on the trading day, price closes red on the day. Okay, the last candlestick. At number 3, the first 5 minutes of the open, we go green. The 2 candles are not touching. Our bullish kicking pattern is in force. And just for information, just look at both those red and green candlesticks. There are absolutely no shadows present. So how would you trade it? Well, we're going to do the exact opposite as the bearish one. So keep in mind, this is a 5-minute chart. Okay, you could even drop lower to find a price pattern, as we talked about earlier. A simpler version is just to buy the break of the high, the completion of the kicking pattern. Okay, they're not complicated plays, but we have to ensure that we have a price point where we will exit if price does collapse. So unlike some chart patterns, the kicking pattern does not have a built-in guideline for targets, like a measurement of the impulse leg or height of the price range. Now, there are 2 rules of thumb you can use for stops if they fit your risk protocols. The first one is you can look to exit at a loss if the current price breaks 50% of the range of the previous candlestick. The second one is just use the low of the entry candle or a low of the second candle in the kicker. Now, profit targets, I always say, they're personal preference. And you just got to know what kind of trader you are. If you're a scalper, you might exit at the first sign of red after trading a bullish kicker. Risk reward targets may come into play where you will exit at 2 or 3 times whatever your risk is. Trailing stops. You could trail under each candlestick low in an uptrend or just use an average true range trailing stop. So the kicking pattern, it's a powerful reversal pattern. Okay, it shows an obvious change in market sentiment. You can trade the pattern in a few ways. You can use a daily chart where the kicking pattern gives you the bias on lower time frame setups. You can use intraday time frames where you trade the kicking pattern as the setup. The difference between the two is one is purely informational. That's the daily chart. The second one is the tradable setup. As I always say, nothing's guaranteed. So ensure you have your risk protocols in place. So the losing trades, when they come, they are unable to wipe out your account. Thanks for watching. Any comments, any other questions, clarify anything, put them in the comments below. Hit subscribe, like the video. Talk to you soon.